Hello, welcome to Unit 7 of Taxation of Electronic Commerce. This unit begins a two-part study of state income taxation of electronic commerce. As we did in our study of sales and use tax, we begin this study with seller nexus. As with sales tax, a state cannot impose its income tax on a seller unless the seller has substantial nexus in the state. That is, the state must have jurisdiction over the seller before it can impose its income tax. While there are similarities in the way we determine nexus for a state income tax and state sales and use tax, there are significant differences, so let's discuss what those are. First, while Quill versus North Dakota uses a bright line physical presence test to determine nexus for sales tax, the Quill rule applies explicitly only to sales and use tax. Some state courts have extended the rule to income tax, but rulings in this area are not consistent, and we cannot say that a physical presence rule applies. Moreover, there are a number of states that have adopted a rule that a vendor has nexus in the state when sales in the state reach a certain level, even if the vendor has no physical presence in the state. This type of rule is inconsistent with a physical presence requirement. Another major difference in sales tax versus income tax nexus is Public Law 86-272. Under this rule, which applies only to state income tax, a seller with physical presence in a state does not have nexus in that state if its only activity in the state is solicitation of sales of tangible personal property and certain other requirements are met. Public Law 86-272 is a major benefit to online vendors. However, there are difficulties in applying the rule. For example, a major question arises as to whether digital products are tangible personal property that are covered by this rule.